Good afternoon, everyone, and welcome to today's briefing on Fringe Benefits Tax, FBT, which I'll be referring to throughout the course of this presentation. My name is Ali Suleiman, and I'm the Employment Taxes Partner at Pitcher Partners. In today's online briefing, we'll be providing with an update to some of the key FBT changes that have occurred during the current year being 31 March 2022, and we'll reinforce some of the key FBT fundamentals. In terms of any questions you may have, there is a dialogue box within Zoom where I encourage you to submit any questions that you may have. Time permitting, we'll be seeking to answer these questions at the conclusion of the presentation. However, please be assured that if we do run out of time, we will follow up with the outstanding queries we receive, whether via email or by direct telephone call to the person providing us with the questions. We'll also provide our contact details at the conclusion of the presentation, so please feel free to either email or call us with any of your concerns, questions or issues. Alternatively, you could reach out to your regular Pitcher Partners contact or advisor, and they can certainly get in touch with us if they need to. So before I begin the presentation, I do need to point out some housekeeping matters. Obviously, this is our disclaimer slide, and I'll just mention some of the key points in the interest of time. Look, we're not purporting to provide legal advice, and this is only general advice that hasn't been tailored to your particular circumstances. We ask that you don't distribute or copy this presentation without our consent beforehand. And look, there's a few other important points on that slide, but I'll leave it to you all to explore further in your own time. In today's presentation, I will be joined by both Elena Bogomolova and Gary Matthews. Both are extremely experienced practitioners that specialise not only in FBT matters, but also in the other employment taxes, such as payroll tax, work cover and superannuation. So we'll be performing a bit of a tag team with the presentation today, where I'll be covering off on some of the basic concepts relating to FBT and some of the key dates, rates and thresholds before handing over to Elena to discuss some of the FBT recent developments. And then Gary will bring us home with some of the common issues that we see with our clients. So hopefully there'll be some tips and traps coming out of the presentation that you might find useful. So before I launch into some of the FBT basic concepts, I just wanted to talk a little bit about what we've seen, particularly over the 2 years with our COVID interrupted period. But one of the things I've learned myself is that before you start a press conference or a presentation such as this, you need to provide some statistics for the crowd to set them up and then encourage them all to go and get boosted, in this case against FBT. So in the spirit of statistics, and to give you some context as to the complexity of FBT, in the 2019 year, and then these statistics are coming from the ATO, in the 2019 year, FBT made up 0.9% of all tax collections, compared, and if you want to compare that to individual income tax returns, you know, the personal income tax filings, that made up 51.2% of all tax collections, and company tax returns made up 21.1%. So FBT is less than 1%, so it's definitely not a significant tax collection regime. You know, the net FBT collections were 3.82 billion from around 70,000 lodged returns. And again, if you compare that to the individual income tax returns, the personal returns that we all lodge, the collections there were just over 200 billion, 213 billion to be exact. And just then to illustrate the complexity that sits behind an FBT return compared to the level of collection, according to ATO data, it takes about 11 hours to complete the average FBT return. Whereas if you want to compare and contrast that to the completion of the average BAS, that takes about half an hour. So you can see with those statistics, there's a significant administrative and compliance burden imposed by the FBT regime, which appears out of step with the level of collection. But notwithstanding that, you know, I do want to caution you, the ATO will still have a significant focus on FBT because it estimates the FBT, you know, the tax gap, the level of uncollected tax from FBT, to be around 22.6%, or again, just to drown you in the statistics, over $1 billion. And again, this is based in 2019 figures. So as a percentage, this is higher than any other tax shortfall that the ATO may have identified, whether in the individual income tax space or the company tax space or wherever else, GST and so forth. So it is a significant tax gap or shortfall, and it is a focus area. And just to round that out, as always, the ATO focus areas are on things like cars, employee contributions, entertainment, and car parking valuations. That's what they've highlighted that will be their focus for the 2022 year. So if we move along to FBT and the basic concepts around FBT, just to get an understanding of what is a fringe benefit. Well, originally it was an integrity measure introduced in 1986 to ensure that all forms of remuneration provided to employees were subject to appropriate taxation. It is a separate tax and it is paid by employers, not employees. And obviously it relates to the benefits provided to employees by employers. And as you can see from the definition is very broad. Benefit includes any right, privilege, service or facility. It's provided by an employer, associate or third party under an arrangement, and it's provided to an employee or even an associate of the employee, such as their spouse, and in respect of the employee's employment. And the employment can be, current employment or past or future employment. And the thing to note about the definition of benefit is it's extremely broad. It captures, if you wanted to think in this way, the net has been cast wide. It captures everything, and the only reason why not everything is taxed under the FBT regime is then it has a comprehensive set of exclusions. So even salary and wages are prima facie fall within the definition of a fringe benefit, but then it's specifically excluded from the definition. So salary and wages are excluded, things like termination payments are excluded, employee share scheme arrangements, and even some deemed dividends that we might see in the privately owned space are excluded from falling within the deemed within the FBT regime. So key to the concept of levying FBT is the concept of employment, and so and the benefit being provided in respect of employment. And so you need to work out, well, who is an employee? And the definition of employee is couched around a person who's in receipt of salary and wages, which leads to a PAYG withholding obligation. So long as there is a PAYG withholding obligation in respect of the payment, then the FBT rules are prima facie invoked. And as with all things FBT or tax in general, there's an extended definition of what an employee is. So if you try and not provide a cash payment, for example, that would be subject to PAYG withholding to get around the employee requirement, there's a deeming rule that says, well, okay, let's say you've provided a particular person with a benefit. If that was provided in the form of cash, would that be subject to PAYG withholding? So there is a way of capturing there's an extended definition of employee to capture those type of arrangements. The other factor to bear in mind, particularly again in light of a small and medium enterprise or privately owned family businesses, is that the benefit needs to have a sufficient or material connection with the employment. And so the key thing here is to determine whether the facts and circumstances support whether the benefits being provided to the person in their capacity as an employee, or as we see in a lot of circumstances, in their capacity as a shareholder of the company or as a beneficiary of the trust that is also the employer. So it's important to look at all the facts and circumstances and to understand in which capacity is the benefit being provided. So moving right along, as I mentioned before, the FBT net is cast wide, and as befitting that, there's so many different benefit categories. There's things, the familiar categories, obviously cars, car parking, loans. If a loan's forgiven, the debt waiver rules can be invoked, expense payments, and then you can run through that comprehensive list, and there's the old catch-all residual fringe benefit. So if you get out of all the other categories, that you might still fall into the residual fringe benefit category. Why are all the categories important? Essentially, it's important to understand where you fall, because you might not be able to take advantage of the different valuation methods or the concessions that's available in some of the different categories of FBT. For example, cars have the statutory method of valuation, whereas when the car is owned by the employer or it's been novated, the car obligation's been novated to the employer. However, a car that's owned by an employee won't qualify as a car fringe benefit. It's likely to be an expense payment fringe benefit, and in that case, you're not able to apply the statutory method of valuing a car. And we'll talk a little bit more about that in some of the examples later, I think in Gary's part of the presentation. I suppose the other, I touched on this before, as I said, the category is important for the valuation methodology. We also need to be mindful of the fact that most benefits will need to include GST in part of the valuation in terms of cost of what's being provided. So just also bear that in mind. In terms of determining taxable value, the other thing to be alert about, and as I said before, FBT was an integrity measure, net was cast wide, and over the years, more and more exemptions have been put into the FBT regime. So let's always be mindful of the exemptions that are available. Some of the general exemptions you might be familiar with, the minor benefits exemption for amounts incurred infrequently and under $300. Might be an amount that's a work-related item, like a laptop or something like that, that's predominantly used for work. Well, then there might be some specific exemptions, like as I've got listed there, in-house childcare facilities, or as we'll talk about later, I think in Eleanor's presentation, the emergency medical assistance type benefits being provided. And if you can't get a full exemption from FBT, there might be a reduction you can apply, whether in part or full, under the otherwise deductible rule. This is where, for example, if you had the employee incurred the cost of the benefit themselves directly, would they get a deduction for income tax? Alternatively, another scenario where there might be a reduction in the taxable value of the fringe benefit is if the employee provides a contribution towards that benefit. Now, in the interest of time, I'll move through the key dates, rates, and thresholds rather briefly, but I will point out some of the salient points. As always, year end 31 March, and so that's rapidly approaching, only a couple of weeks away now. And lodgement date hasn't changed as in prior years where you don't lodge via a tax agent. That lodgement date is a little bit earlier, being Monday, the 23rd of May. If you do use a tax agent, that lodgement date is extended out by about a month to Monday, the 27th of June. Some of you that have been dabbling in the FBT space for quite a while will recognise that the requirement to make an estimated payment, will recall there was a requirement to make an estimated payment of 90% of your liability by the 28th of May. That has been permanently removed. So it's one of the welcome changes that have been brought about by COVID. As I said before, in terms of rates and thresholds, I won't spend too much time on this other than to say the rates and thresholds haven't changed because none of the percentages have changed. The FBT rate stayed the same at 47%, which means the gross up rates have remained unaltered. And it also means that the caps that exempt and rebatable FBT or employers have available for their employees, that's all remained unchanged as in prior years. And finally, moving on to some of the other relevant rates that apply for the 2022 year, the benchmark interest rate is down in terms of for loan fringe benefits to 4.52%. Car parking thresholds have adjusted slightly to determine whether or not you are providing a car parking fringe benefit. And then as I'll let you work through your leisure as well on the residual vehicles there, the various cents per kilometre rate, depending on the capacity and or capacity of the engine and the type of vehicle. So with that, I'll hand over to Eleanor to talk to us about some of the recent developments in the FBT space.
Thank you, Ali, and hello, everyone. So as Ali said, my name is Elena Bogomolova, and I'm a client director in the Employment Taxes team. I will give you an update on recent developments in the FBT space. Now, one issue which has recently become topical is where employers provide employees with incentives or rewards for getting their COVID-19 vaccination or booster done. Be aware that there may be tax and superannuation consequences in doing so. The consequences differ depending on whether a cash payment, paid leave, or non-cash benefit is provided. If employers provide non-cash benefits, such as gift cards or vouchers, they may have to pay FBT on these benefits unless one of the relevant exemptions is available. The exemptions which can be considered are the minor benefits exemption for benefits valued under $300, work-related preventative healthcare exemption, or in-house benefits exemption. If an employer provides a cash payment, example $200, in cash, this payment should be treated as an additional salary. So the employers need to report the payment by single touch payroll as part of the employee's salary and wages, withhold tax from the amount under PAYG withholding rules. And this payment will also be subject to superannuation guarantee. Where the employer provides paid leave for employees to get their COVID-19 vaccination done or recover from the vaccination side effects, the employees earn salary and wages while they are on paid leave. Where the employer provides employees transport to or from the vaccination, these benefits are generally exempt under the work-related preventative healthcare exemption. Last year, we saw an increase in the use of rapid antigen tests and PCR tests. There are some organizations which have introduced testing requirements for the employees on a daily, weekly, or some other basis. This was viewed as an important measure to mitigate COVID transmission in the workplace. So the question which came up was, if the employer provides rapid antigen tests to their employees, is it a fringe benefit? And if so, what is the treatment from FBT perspective? At the time, the FBT practitioners have agreed that provision of rapid antigen tests is a fringe benefit and started analyzing the exemptions available in the FBT legislation. The obvious exemption, which was considered, was a minor benefits exemption. This exemption is available for benefits which, with GST inclusive value of less than $300, where benefits are provided on infrequent and irregular basis. However, in some circumstances where benefits were provided frequently and regularly, for example, on a daily or weekly basis, the minor benefit exemption could not be satisfied. Other exemptions under the FBT legislations were also considered, and there was some concern expressed at the time that the provision of rapid antigen tests to the employees may be subject to FBT in some circumstances. The question came up whether the otherwise deductible rule can apply. The otherwise deductible rule, as Ali said, is a mechanism within the FBT legislation, which allows the taxable value of a benefit provided to an employee be reduced to nil. And this is a hypothetical test. If the employee was to acquire this benefit him or herself, would it be deductible for the employee? If the expense is deductible to the employee, it is considered to be otherwise deductible for FBT purposes, and the value of the benefit can be reduced to nil. So I understand that there was some active lobbying from various industry bodies and accounting firms, including our firm, in relation to the treatment of rapid antigen tests. Ultimately, the federal government has come up with a fix. And in February 2022, the government has announced that COVID-19 testing expenses would be tax deductible for employees where they are required to perform tests in order to attend the place of work. As such, since the rapid antigen tests are tax deductible, they will be otherwise deductible and there will be no FBT liability. So this rule will be effective for the 2022 FBT returns. Now, we expect that FBT compliance for the 2022 FBT year is likely to be affected by COVID-19 issues, given that we continue to have some extended lockdowns in Victoria in the 2022 year. We have discussed some of these issues in last year's update. I will briefly touch on some of them by way of reminder. So in relation to cars, broadly, if a car is garaged, so a work car is garaged at the employee's home, it is deemed to be available for their private use. And they're likely to be an FBT liability if using the statutory formula method. The fact that the car may not have been driven during the period is not relevant for the purposes of applying the statutory formula method. However, the ATO stated that if the employer is using the operating cost method, in circumstances where a car hasn't been driven at all or has been driven at a significantly reduced level, the FBT liability can be substantially reduced or fully eliminated. But it should be noted that in order to rely on the operating cost method, the employer has to ensure that the appropriate records are maintained. In particular, there are valid logbooks available. And for completeness, I note that where the employee has returned the work car to the employer and the car was garaged at the employee's premises during the lockdowns, the car is not considered to be available for the employee's private use, and therefore no FBT liability will arise during the period. In relation to car parking, in the past, many employers used the statutory formula method to determine a number of benefits provided during the year. This method assumed that car parking was provided on all business days in a year. This method didn't require a lot of records to be kept by the employer. However, as there were disruptions to employees going to the office and using their car parks in the 2022 FBT year, it is important to keep records of the actual use of car parking by employees. The car parking FBT liability can be reduced by days when car parking was not available to employees during the year. So the actual method may produce more favorable results. On a separate note, there are some changes in definitions relating to car parking fringe benefits and small business car parking exemption. I have a couple of slides on these changes and we'll discuss them in more details shortly. A next popular item was working from home equipment. Some businesses have provided working from home equipment to their employees, such as laptops, monitors, chairs, desks, etc. Where the GST inclusive value of benefits is less than $300 and the benefit is provided on infrequent and irregular basis, such benefits would obviously be exempt under minor benefits rule. There is also a specific FBT exemption available for portable electronic devices, such as laptops, tablets, smartwatches, where the benefits are provided primarily for use in the employee's employment and other criteria of this exemption is satisfied. However, if we take an example of a printer, monitor, desk valued at more than $300, the minor benefits exemption does not apply. These items are not portable electronic devices, so this exemption also does not apply. We have to rely on the otherwise deductible rule to reduce the value of these benefits. As such, the question is, if an employee was to acquire such item for his or her home office, would it be deductible to the employee? The answer is that such items are not deductible straight away. They are depreciable assets. So one-off deduction is not available. This follows that the otherwise deductible rule would not apply, and those benefits would be subject to FBT. I know that different FBT outcomes can be achieved when equipment is leased or if or is provided to employees on a temporary basis and is required to be returned to the employer when the employee's employment with the employer is terminated. So it really depends on the circumstances. Now, moving on to meal entertainment. Given the periods of lockdowns in Victoria, it's likely that employers have experienced reduction in entertainment benefits provided. Based on this, it's important to consider which method, the actual cost or 50-50 split method, is likely to provide a better outcome. We've seen last year that some employers switched methods from what they've used in the past due to nature of benefits they have provided. We've also got a lot of questions around the treatment of cancellation fees. Where the event has been cancelled, it's not considered that the benefit to the employees has been provided. So if such expense incurred in the current FBT year, they're not taxable if paid by the employer. Where a deposit or prepayment for the benefit was included in the previous FBT year, in the previous FBT return, but the event has been subsequently cancelled, The correct approach is to rectify this, is to amend and claim refund in the previous FBT return, rather than reduce the value of benefits provided in the current return by this amount. Now, next item is emergency assistance. Broadly, no FBT liability should arise where the employers provide emergency accommodation, food, transport, or other assistance to an employee if the benefit is emergency assistance and to provide immediate relief, and the employee is adversely affected by COVID-19 or is at the risk of being adversely affected by COVID-19. So examples of emergency assistance which can be exempt are expenses incurred relocating an employee, so such as cost of flights, accommodation, food. Expenses incurred for food and temporary accommodation if an employee couldn't travel due to restrictions. Benefits provided that allow an employee to self-isolate or quarantine, for example, payment for hotel quarantine. Paying for an employee's transport expenses, including car hire and transport to temporary accommodation. Typically, those expenses are of temporary nature. There is certain criteria which has to be satisfied for a car parking fringe benefit to arise. Broadly, a car parking fringe benefit is likely to arise when, among other things, there is within 1 kilometer radius of the work car park, a commercial parking station which charges the rate greater than $9.25 for all-day parking. The changes which were introduced relate to the definition of commercial parking station. These changes are discussed in the text rule in TR 2021-2. Previously, it was considered that certain car parks in shopping centers, in hospitals, which charged the penalty rate and really discourage all-day parking were not commercial parking stations. For example, a car park would have a first 2-3 hours free and then charge a penalty rate of, say, $50 per day for all-day parking. Those car parks were not commercial parking stations. This was the line of arguments in the Qantas case, where Qantas argued that the same should apply in relation to airport car parking, and that airport car parking is not commercial parking station. Qantas wasn't successful in that case, and following from that decision, the ATO has issued the text rule in 2021-2. So as a result, the definition of commercial parking station has been expanded to include airports, shopping centers, hospital car parks, and other similar type of car parks. The expanded definition of commercial parking station will now mean that more businesses are likely to be caught as providing car parking fringe benefits. So businesses located near shopping centers, hospitals, or airports may fall within the expanded definition of commercial parking station and should now consider if they have a car parking fringe benefit tax liability. This change will not affect the 2022 FBT year. It will apply from 1st of April 2022. So it will be prudent for employers to review their car parking arrangements and be aware of potential liability. Where a car parking fringe benefit arises, it should be considered whether an employer is able to qualify for a small business car parking exemption. The scope of this exemption has recently been expanded to include more businesses. There are 3 requirements which have to be met to qualify for this exemption. First, meeting the relevant turnover test. The employer has to either have a gross income of less than 10 million on a single entity basis, or be a small business entity based on the group's aggregated turnover of less than 50 million. I note here that the small business turnover threshold increased from less than 10 million to less than 50 million for the benefits provided on or after 1st of April 2021. So this change will apply to the 2022 FBT returns. This is a welcomed change. It will increase a number of businesses which are likely to qualify for this exemption. Please note that the relevant financial year where you need to check the business's turnover is the last year before the relevant FBT year. So for the 2022 FBT year commencing on the 1st of April 2021, the last full income year is the year ended 30 June 2020. Now, the second criteria for this exemption is that car parking is not provided in a commercial car park. And the third requirement is that employer can't be a government body, listed public company, or a subsidiary of a listed public company. Moving on to the next topic, living away from home allowance. So living away from home versus traveling for business. A lot of our clients have employees who are required to travel for business purposes. The basic rules are if the employee is traveling on work, the expenses incurred are tax deductible when incurred in gaining assessable income. So if an employee who is based in Melbourne travels to Sydney for 2 days for work-related purposes, the employee's expenses, such as cost of flight, accommodation, and meals, are deductible. If the employer reimburses those expenses to the employee generally, these expenses are otherwise deductible and no FBT liability arises. On the other hand, when an employee is required to live away from home for a period of time, the employee's usual living expenses, such as cost of accommodation and food, are private and domestic in nature and generally are not deductible. Also, there is a long-standing principle that the cost of transport for the employee to travel to their place of work is their private expense and not tax deductible. So broadly, if employer reimburses employees' private expenses, the FBT liability may arise unless the expenses fall within the living away from home allowance fringe benefit exemption. I will discuss the criteria for this exemption shortly. So as you can see, the distinction between employees traveling on work and when employee is living away from home is very important. One of the main factors in determining whether the employee is traveling on work or living away from home is the duration of travel. The most recent guidance issued by the ATO is the tax ruling TR 2021-4 and the practical compliance guidance PCG 2021-3. These documents provide a lot of useful examples. Broadly, the ATO will accept that the employee is traveling on work when the employee travels for less than 21 days at the time. So less than 21 days at the time. And for a total period of no more than 90 calendar days for to the same work location in the FBT year. So 21 days at the time, but not more than 90 calendar days to the same work location in the FBT year. The guidance also states that where the employee is required to travel, there is no change in their work location. And when they're traveling, the employees are typically staying in a short-term accommodation, like hotels or service apartments. By contrast, when the employee is required to travel and stay at a location for a longer term, they're likely to be viewed as living away from home. Typically, in those situations, the employees are likely to be staying in rental properties and their accommodation becomes their usual place of residence for this period. Employees can also bring their families with them. So while the guiding principles are fairly simple, in practice, we see some tricky situations where it becomes difficult to determine whether the employee is traveling for business or living away from home. Now, I'll say a few words about living away from home allowance, what we call LAFA. LAFA is a fringe benefit which occurs where an employee is paid an allowance to compensate them for any additional non-deductible expenses incurred as a result of them being required to live away temporarily from their usual place of residence in order to perform their employment duties. So, for example, an employee who lives in Melbourne is required to work from a site in regional Victoria for a period of 6 months. It's not practical for the employee to travel home every day. So the employer provides employee with the living away from home allowance. Now, these payments are to compensate employee for their private expenses. So they're considered to be fringe benefits. So generally, LAFA can comprise of 2 components: payment for accommodation and payment for food. There is no set limit in relation to payment for accommodation. It just needs to be reasonable expense and need to be substantiated. For the food component, each year the tax office publishes reasonable rates. If employer pays at a higher rate than the ATO reasonable rate, the excess is fully taxable. It's usually advisable to have written agreements with employees in relation to LAFA. Let's now consider requirements for living away from home exemption. So when would LAFA be exempt? I note here that the exemption is only available in temporary relocation scenarios. It's not available where employee has permanently relocated. So usually it's a question of fact. So the first requirement is that the employee must maintain a home in Australia for their immediate personal use and enjoyment and be living away from it. So if you have an employee coming from overseas, it's unlikely that such employee would have a home in Australia from which he or she is living away. Also, you might have employees who are living at home with their parents and do not own or rent their own homes. So concessions are not going to be available to these employees. Employer has to collect declarations from employees to confirm that they're living away from home. Now, this concessional treatment is only available for 12 months. If you have a project which is projected to run for 12 months, but ultimately runs for longer, after 12 months, these payments become fully taxable. I will also note for completeness that these exemption requirements are not applicable to, and they are fully waived for rotational workers who are on fly-in, fly-out and drive-in and drive-out arrangements. So this concludes my part of this presentation, and I will pass on to Gary now to discuss some common FBT issues which we see in practice.
Okay, thanks very much, Eleanor, and welcome everyone. Just by way of background, I also work in the employment taxes team in tax advisory, and I have considerable experience, probably been with Pitches for 24 years on and off, and in the tax space for probably, I think it's 34 years now, so getting along quite nicely. So what I'm going to talk about in this particular session is just some of the common issues and traps in relation to FBT. And these issues and traps are borne out from our experiences, as well as through audits with the ATO, etc. So these are real practical live examples of issues that you may encounter. And quite frankly, I think you should pay attention if they apply to your particular case. Okay, what I'll be looking at is motor vehicles. It's obviously the biggest big ticket item as far as FBT is concerned. We'll be looking at entertainment, living away from home allowances. I'll just quickly touch on a couple of points, as Eleanor obviously has covered that pretty well so far. Just looked at a couple of other issues in relation to the treatment of exempt benefits and whether or not a benefit may qualify. And finally, classification of benefits and how that can impact. Okay, the first area I want to talk about is in relation to exempt car benefits and exempt residual motor vehicle benefits. Now, you may be aware, and certainly we've covered this in the prior year's session, but we think that it's very important for those that it does apply to. So you may be aware that there is an exemption in the Act for certain types of cars that can, and also other motor vehicles subject to certain conditions. And basically they are cars which are utes, panel vans, or dual cabs, which have a carrying capacity of less than 1 tonne, okay? Or other vehicles, it doesn't matter what type of vehicle it is, any other vehicle which has a carrying capacity of greater than 1 tonne. Okay, so those vehicles are eligible for exemption. Now, basically the exemption will apply where the vehicle is only used for work-related purposes, and that includes travel between home and work for the employee. So you might be giving a ute to an employee to carry all their tools from site to site, and they're also permitted to take it home at night. The travel between home and work is considered to be work-related for this exemption. However, any other private use must be minor, infrequent, and irregular. And this is where really the whole issue comes to a head. We find that there are a lot of cases where employees are given these types of vehicles, but unfortunately the private use is greater than what would be considered minor, infrequent, and irregular, and they don't actually qualify for exemption, notwithstanding that that particular employer has treated them as exempt. Now, the Commissioner a few years ago issued a practical compliance guideline, number 2018-3, which focused on circumstances in which he would consider whether to devote compliance resources to investigating the use of such vehicles, these utes, panel vans, or other vehicles with a carrying capacity greater than 1 tonne, whether he would or not. Now, basically, if we had a situation where an employee was provided with one of these types of vehicles, let's say it's a ute, it could be a dual cab ute, or just a normal ute. Let's say they're provided with a ute, okay? It's provided for work-related purposes and is not salary packaged, so that's important. And also the vehicle does not exceed the luxury car limit in terms of its value. For the current FBT year, that would be $69,152. So if it didn't exceed that amount, there is a higher exemption for fuel efficient vehicles of 79,000 odd. But if it didn't exceed those values, then subject to private use patterns being appropriate, they will not, the Commissioner would not drill down any further. And basically the requirements are that firstly, that there is a policy in place restricting private use to basically that which is minor, infrequent, and irregular, that the employer using that vehicle does not travel more than 1,000 kilometres per annum on wholly private travel, does not have any single private trip exceeding 200 kilometres in any one trip. So you can't have a situation, say, where an employee has a ute and they decide, subject to their employer's approval, to go to, say, Sydney on a holiday from Melbourne and back. Obviously, that would well and truly breach that test. And the other test that the Commissioner would apply is that where the employee travels between home and work, any diversion for private purposes can't exceed more than 2 kilometres in any one trip. So in other words, the employee may have a ute and is driving their child to work, to school. That diversion to drive the child to school can't be more than 2 k's out of the way between where they would normally travel between home and work. Okay, so if that's the case, then the Commissioner will be satisfied. If you can satisfy the Commissioner that that is what is occurring right now, then the Commissioner won't focus more heavily. Okay, if you can't satisfy the Commissioner of those tests, you can still argue that the exemption should apply, but you're going to have a pretty good argument if private use exceeds those limits. Really, it's not really going to be sustainable. So really, as a guide, I think it's important that you use this as a guide to what levels of private use the Commissioner will accept with these exempt vehicles. Okay, now if the workhorse exemption does not apply, and it doesn't apply outright to any sedans or SUVs or station wagons, they are not, unless they have a carrying capacity greater than 1 tonne, which is highly unlikely, but otherwise they are a car fringe benefit if the carrying capacity is less than 1 tonne. And if a logbook is kept, you've got the option of using either the lower of the operating cost method or the statutory formula method, and you can chop and change and use whatever method suits in any given year. You don't have to use the same method for the same car year after year. You can chop and change depending on what has the best outcome. If no logbook is kept by the employee, then you have to use the statutory formula. Okay, so that's the only valuation method you can use for car fringe benefits. Now, a vehicle which has a carrying capacity greater than 1 tonne, which doesn't satisfy the workhorse vehicle exemption based on the tests that I just discussed, you will have a liability for FBT on that as well. Now, just remember, when looking at or valuing these vehicles, you must consider home to work travel in those cases to be private use. So if the exemption doesn't apply, then home to work travel is always considered private use. Okay, if you're able to provide, or the employer is able to provide, a reasonable estimate of their business percentage of use over the total year, then you don't need a logbook. If it's a residual vehicle, i.e. carry capacity greater than 1 tonne, you can use the operating costs in those cases. There is a second method you can use to value residual residual motor vehicle benefits, and that is what we call a cents per kilometre method, which basically you apply a rate per kilometre to the estimated private use of that vehicle in the year. So you might estimate a vehicle is going to be used 5,000 kilometres for private use and apply the applicable rate. Now, just be mindful that the rate you apply for under this method is not the same rate as the rate that the Commissioner approves as reasonable for reimbursing employees for business travel. So that is a separate rate. There is a separate rate in the FBT for these types of vehicles. Okay. All right, just quickly to touch on to some of the more common issues with car fringe benefits. And firstly, base values. That's always an issue as far as we're concerned. You've got to ensure that with the base values, you exclude all stamp duty and registration costs incurred in purchasing that vehicle initially. Okay, they must be, or they can be excluded. You must include GST though in the valuation of that vehicle. If a trade-in is provided when the vehicle is acquired, if the employer provides that trade-in, then it will not reduce the value of the car for FBT purposes. However, if the employee provides the trade-in, then it will reduce the value of the car for FBT because it's not a cost incurred by the employer as such in providing that trade-in vehicle. If you've got new employees that have a pre-existing arrangement with their former employer, then the base value will be based on the market value at the time that the employee commences work with that new employee, subject to the fact that the old employer and the new employer are not associates. Okay, so if they're completely unrelated, then you just use the market value at the time the employee commences. If you're going to say enter into a novation agreement that the employee previously had with their old employer. If it's a business acquisition, generally, and it's you've acquired the business, from an unrelated party, not a non-associate, then again, it will be, the valuations will be based on the market value at the time the business was acquired. Okay. Now, one of the things we can't stress too much is in relation to logbooks. If you're going to use the operating cost method and obviously rely on a logbook, make sure that logbook is valid and conforms with all the requirements under the ATO guidelines. That is that appropriate entries are kept for all business use. The logbook is kept for a full continuous 12-week period, and all the entries for each day, each trip, are in sufficient detail to allow the Commissioner to be able to make a determination, yes, we accept that that is a business-related trip. So just writing business, private, business, private, business, private down in the entries is insufficient. You need some narration there, like travel to client premises in Braybrook or something to that effect. So make sure the logbook is valid and that it's kept within the last 5 FBT years, counting the current year and or the prior 4 years. If it's outside that period, it cannot be relied upon whatsoever. Okay, also who holds the vehicle is very important. With novated leases, you must ensure a novation agreement is signed such that the employer is then deemed to hold the vehicle. Without having a novation agreement signed, it's held by the employee and it's an expense payment benefit rather than a car fringe benefit. If it's a hire purchase in the employee's name, you cannot novate that agreement. It is always going to be expense payment benefits and not a car fringe benefit. Now, just one other point on cars, pooled or shared cars. Now, if you have a car in which more than one employee uses it for private purposes during an FBT year, that is by definition a pooled or shared car, as far as the FBT Act is concerned, or the regulations, in fact. Now, that will still be subject to FBT, that car, but it's just not reportable on either employee's payment summary, or what was formerly payment summary. Now, when you report through STP, they're reportable fringe benefits. So not reportable, but still subject to FBT. Okay. Now, just an example of classification of benefit and why it's important to make sure that when you have a benefit provided, that you get it right in terms of what type of benefit it is. So I mentioned before that an example where an employee hire purchases a car. Okay. Now, as I said before, you cannot novate a hire purchase under the FBT Act. There is a provision that actually specifically prohibits that in broad terms. Okay, so an employee hire purchases a car in their own name, and it's a $40,000 car. The intention was in hire purchasing it that it would be packaged with the employer. But unfortunately, as I say, you can't novate it. It's in the employee's name. Therefore, any expenses paid in relation to that car, including the HP repayments and the running expenses, will all be considered expense payment benefits. If they were to total $20,000 per annum, then that effectively is the taxable value of that benefit. If, however, the employer had hire purchased it in their name, or alternatively it had been leased and not hire purchased, and then there was a novation agreement in place, we could then consider it a car fringe benefit. And in this particular example, you would have an $8,000 taxable value being 20% of the $40,000 base value. So a market reduction in the taxable value just by getting it right. So it's very important always to understand what's going on, what the documentation says, to make sure you're getting that classification correct. Okay. All right, just very, very briefly, with living away from home allowances, we do see this as an area that the ATO will focus on if you've got any of those types of benefits provided to employees. Just be absolutely sure that the employee has an ownership interest in their usual place of residence. So if you've got 2 employees both going to a site for 6 months to do a job, one employee owns their own home and the other happens to be a young bloke who lives at home with his parents, he doesn't have an ownership interest in his usual residence, therefore he can't qualify under the living away from home allowance rules. Whereas the older gentleman that owns his own house and is being relocated for that 6 months will qualify for the LAFA concession. So it's very, very, very important to get that right. And also that usual place of residence is continuously available for the employee's private use and enjoyment. So that older bloke that gets sent to the site, so long as he doesn't rent it out to unrelated third parties, and it's still available for him for his private use, that's okay. He could have someone live there while he's away, so long as he can access it when he comes back freely. Okay, there's also a strict 12-month rule, so it's only ever LAFA for 12 months. Beyond that, no concessions will apply and it'll be fully taxable. And it's so crucial that you get the declarations in place that confirm that the employee had an ownership interest in a residence, etc. So make sure you get those declarations, because otherwise the ATO may disregard them and may not allow any of the concessions, etc. All right, we'll just move on to the next slide. Now, entertainment is one of the, probably next to cars, is probably a key area with FBT. What is the first thing we have to be satisfied is that the benefit, in fact, is an entertainment benefit. Okay, so entertainment by definition includes entertainment by way of recreation and meal entertainment, and also accommodation and travel provided in the course of providing that entertainment. So I fly up to Sydney to attend the gala ball for the firm, and I'm put in accommodation. The flights up, the accommodation, as well as the cost of the ball are all entertainment benefits and have to be included. But if I travel to Sydney on a business trip and happen to then go to a ball while I'm there, but that's not the real reason I was there, then obviously the cost of the ball would be caught, but the travel and accommodation would be considered to be business related and therefore fully otherwise deductible or not subject to tax. Okay, the other issue with entertainment is you want to be satisfied that the benefit you are providing is entertainment. We always have this issue about, is something entertainment or is it sustenance? Okay, sustenance is generally where the main purpose of providing a benefit is to sustain an employee. So let's say you have a meeting in the boardroom and you have sandwiches during that meeting. Well, that's to sustain, it's not to entertain. Okay, also a common one is, say, like employees go and get coffee or something like that and put it on their corporate card. Now, generally just a coffee on the corporate card would not be considered entertainment. It's low value. It's not, the purpose is not to entertain, but to sustain. So we accept that that's not entertainment. And a lot of employers will provide, apply, say, a $15 rule or something similar to that. Say if the cost per head is less than $15, we'll just accept that as sustenance because it's not really that significant cost, and that's a good way of just excluding certain benefits from consideration, any further consideration. But generally, when we look at entertainment, we ask a few questions: what's being provided, when it's being provided, where it's being provided, and why. So those are the key tests we look at to determine if something is entertainment. Just remember, as I say, not everything has to be entertainment. You could find that a lot of costs that you put to the entertainment account are in fact sustenance. Now, sustenance is still strictly subject to FBT, but generally we accept that it's a minor benefit if the costs are incurred infrequently and irregularly. If the guy goes down and gets a coffee every day, every working day that he's there and puts it on the corporate card, we would say it's subject to tax. It's not entertainment, but it's still subject to tax, being a frequent and regularly provided benefit. Okay, so just moving on. When you have entertainment benefits, you have a couple of choices. If you provide recreational entertainment, you must use the actual method of valuing, and that is to just value it as a property expense or residual benefit. If you provide meal entertainment, food, drink, or the travel associated with providing that food and drink, then you can use the meal entertainment election, which is generally the 50-50 split method. So you take 100% of all the entertainment costs incurred throughout the year and declare 50% as taxable. If you use the actual method, then there are some exemptions that you can apply. Property consumed on business premises on a working day, for instance, will be exempt where it's provided to the employee. You can use a minor benefits exemption if the value per head is less than $300. And client entertainment is not considered to be subject to FBT. It's not provided to an employee. Okay, if you're a tax exempt body, then there are certain rules that apply, and generally most of that tax exempt body entertainment must be declared. You can't use the minor benefits exemption or property consumed on business premises exemptions. If you use the meal entertainment election, as I said, it's 50% of all costs. You can't exclude minor benefits or property consumed on business premises, which is entertainment. So they must all be included in that 50-50 split. So just be mindful, if you're going to make a choice between either, just be mindful what's going to produce the lowest cost. And the easy way might be to go 50% meal entertainment election, but with a little bit of work, you may in fact save a whole lot of money by using the actual method, because the exemptions available may far outweigh the ease of using the 50% 50-50 method. Okay, and just quickly to cover off, mindful of the time, we're getting close to the 1:30. You can apply a minor benefit exemption to any benefit you provide, generally, except if you're a tax exempt body, you can't apply it to meal entertainment. Entertainment generally. Now, minor benefits exemption can apply where the GST inclusive value of a benefit is less than $300. Make sure you include the GST in making that decision. It's not exclusive, and it's also less than $300, not strictly $300. Also, it must be a benefit provided on an infrequent and a regular basis. So, you know, generally, if you give 2 or 3 gift vouchers per year to an employee and they're each less than $300, you would exclude them. But if you provided one every month to the same employee, you would say it's probably frequent and regular, and therefore you can't exclude it. And the frequency and the regularity will vary depending on the nature of the benefit and its value. Even though it's under $300, if it's close to $300 each time, it's going to be less frequent that we can accept is minor than if it's, say, like only $5 or $10, where obviously frequency can be much higher. Okay, and this could be applied for things like staff gifts, ad hoc functions, etc. Say like you get flowers for an employee because it's their wedding or whatever, stuff like that can apply. Eligible work-related items, just quickly to cover off, years ago, going back about 2007, before that, you could salary package a laptop computer and no questions asked. It was exempt from FBT. But there are certain restrictions now, and generally what we call portable electronic devices, which include laptops and mobile phones, can be provided so long as they're provided primarily for use in employment. And if you provide those, so the title remains, you provide those to the employee, then they will be exempt if it's primarily for use in employment. And if the employer retains title to those, say that mobile phone, then all the core costs related to that will also be considered 100% exempt. If the employee provides their own phone, then you would have to use the otherwise deductible rule to reduce the expense payment benefit taxable value. So who owns a mobile phone can affect things quite significantly. Okay, so yeah, and you can't salary package generally these type of exempt eligible work-related items, because salary packaging generally suggests that there is a private benefit and it's not just primarily for use in employment. Okay, and just quickly to finish off today, just make sure always you use GST inclusive values. It's absolutely important, especially with entertainment. We often find that employers extract the values from the accounts, but forget to that one step of multiplying by 1.1 or whatever, just to bring it back to the GST inclusive value. And as I highlighted before, classifications of benefits is crucial. So if it's a HP, as I mentioned, but it could also be things like car parking. If an employer provides car parking, it's subject to FBT as a car parking benefit. If an employee pays for car parking in their own name and then gets it reimbursed, then generally it will be an expense payment benefit and the concessions won't apply. Also, make sure that you classify benefits correctly as type 1 or type 2. That is, if they're type 1, they no GST did apply to them, as in the provider of the benefit did incur GST in relation to that benefit and had to pay it, whereas type 2 is generally GST free or input taxed benefits. And documentation and substantiation are absolutely critical. The ATO, whenever we do a review, will always focus on your documentation and substantiation of your benefits. And in a lot of cases, will deny you exemptions or reductions in taxable values, etc., if there's a lack of appropriate documentation. So always get the declarations in from employees, always make those elections that you're required to do so, retain copies of invoices or receipts so that they can be brought up if necessary. I understand we are over time now, so we would normally have a Q&A, but unfortunately, given some of our technical difficulties, etc., we've run a little bit over time. I noticed that there are a number of questions in the Q&A. We won't, unfortunately, be able to answer those now, but we will certainly respond back to the people asking those questions directly in writing to them within the next 2 or 3 working days. Beyond that, on behalf of Ali, Eleanor, and Pitcher Partners generally, I'd just like to thank you all for coming, I should say, logging into this webinar. I hope it has been of some benefit to you, and always be mindful that if you need any assistance, you can always come and ask any of the 3 of us. Have we got that slide there, Eleanor? That with our contact details? Our contact details are there. By all means, please use those. or contact the firm generally, but we're more than happy to assist you with any queries that you may have. Thank you very much for coming today and have a great rest of the day. Thank you.